It's now time to turn to the double patterns, double tops and double bottoms. A double top consists of two peaks that culminate a rally. They're separated by a reaction or valley in prices. The formation is completed when the price breaks below the lower level of the valley. Its principal characteristic arises from the fact that the second top is formed with distinctly less volume than the first. It's normal for both peaks to develop at the same price level, but it's also possible for the second peak to slightly exceed the first or to top out just a little below it. The reaction from the first peak to the valley is usually associated with a trend of declining volume. Remember, this is not an exact science, but a common sense interpretation of a battle between buyers and sellers. The basic concept is that the second peak is a test of the first, and that if this test is unsuccessful, a double top formation is more likely to be completed. The underlying psychology might work something like this. The first top develops at the end of a substantial rally. Volume is heavy and sentiment very positive. Then prices unexpectedly decline on contracting volume and disappointment sets in. This is then followed by a rally. Rising prices then attract more bulls as it progresses, and the bullish arguments that were associated with the first peak become more believable. However, the second peak is accompanied by far lighter volume than the first. To the technician, this is a bearish factor because it indicates less enthusiasm by the buyers and suggests that prices are rallying more from a lack of sellers than anything else. They subsequently decline again and break below the lower level of the valley, separating the two peaks. At that time, the pattern is completed, and everybody who bought during its formation, that's the red shading, is coming home with a loss, and therefore is a potential seller. In their book Technical Analysis of Stock Trends, Edwards and McGee point out that double tops are referred to by name, perhaps by more traders who have a small knowledge of technical analysis, than perhaps any other pattern. They go on to point out that these neophyte technicians in most cases identify these patterns before they've been completed, which is a definite no. According to Edwards and McGee, double patterns are extremely rare, and that certainly appears to be the case with double tops, but not so much for double bottoms. In doing research for this presentation, I ran through countless charts covering well over 10 years of data and was unable to find many examples of true double tops. This chart features a double top for Jefferson Pilot. In this case, the price moves down to the effect of several times the downside objective. This is by no means a classic example, because a heavy volume on the first high, followed by very little activity on the second, is just not happening. Double top review. Price characteristics. Two highs followed by a worthwhile rally that form at approximately the same level. They're separated by a decline and a decent time interval. Pattern completed, with a decline below the valley low. Volume considerations. Heavy volume on the first top, substantially lower volume on the second. Price action of a double bottom is exactly the opposite of a double top. These formations are typically preceded by a very sharp price decline. An example is shown in this diagram. An initial low is formed on pretty heavy volume, often a selling climax. A subsequent price bounce retraces some of the ground previously lost. This advance then gives way to a decline that tests the initial low. When the price rallies above the bounce high, the pattern is completed. Typically, volume on the second low is extremely light, especially when compared to the initial bottom. A decided plus develops when the level of activity expands on the upside breakout. Volume in double bottoms is as easy as 1, 2, 3. In effect, we get high volume on the first low, that's 1, lower volume on the second, that's 2, and expanding activity on the breakout, that's 3. The volume characteristics described here are not mandatory, since many patterns do not reflect such characteristics, yet still appear to work. Just like that double top for Jefferson Pilot in the previous slide. If the characteristics are present, the probabilities of a valid formation will be much greater. Usually the second bottom is formed above the first, but these formations are equally valid, whether or not the second reaction reaches or even slightly exceeds the level of its predecessor. The first thing to do whenever entering a trade is not to ask how much money you're going to make, but what is your risk if things go wrong? And that risk is determined with a reference to the point on the chart where the technical event you're monitoring is actually cancelled. In this case, the technical event is a breakout from a double bottom formation. The obvious risk point from this diagram is below the level of support flagged by the second bottom. Now for me that would be far too much risk relative to the potential reward. Some people take the 50% level as the point of balance. In other words, place the stop just below the 50% point of the rally. I'm not that keen on that kind of approach either. Sometimes we get a break. Let's say this is a daily chart and we can pull up an hourly one and get some more detail. Sometimes, as in this situation, we can spot a natural support zone, such as this minor low. That would give us a much better risk-reward ratio. The recommendation from all this is make a habit to look above the time span you're actually trading, and also the time span below it, where you might be able to spot something that's not apparent in the actual time span you're trading. Here's a daily chart of Lockheed Martin. We see a nice double bottom with reasonable volume characteristics. I would have liked to have seen less activity at the second bottom, but it was definitely lower than the first. If you bought on the breakout above the green trend line, it would have made sense to place a stop below the previous minor support low just here. However, there's another dynamic to the chart, and that's the fact that the second bottom was a form of reverse head and shoulders, and it was also possible to buy on a break of the dashed trend line with a stop below the right shoulder just here. Like all patterns, double bottoms are occasionally subject to failed breakouts. Typically this is going to happen during a bear market, when the breakout is a contra-trend signal. An example is shown in this chart of KB Home. At the time of the breakout, it looked to be a perfectly normal reversal pattern completion. The price breaks above the rally separating the two bottoms, and the volume configurations look good. Heavy activity on the first low, less on the second, and a noticeable pickup on the rally. However, when we see more price action, it's on the downside. The problem was that this formation developed towards the end of a bear market. In this case, a convenient failure indication was given when the price broke below the dash support trend line. It's doubtful if this would have made a good risk-reward trade anyway, and that's because the distance between the breakout point, $16, and a place just below the second low at $14 would have involved a risk of about 18%. As we saw earlier, if the price rallies sharply off the second bottom, buying on the breakout could involve a considerable price risk. That's because in many cases the only viable support point under which to place a stop is the second bottom itself. However, during the formation of many secondary bottoms, the price declines under the constraint of a resistance trend line as shown here. When it breaks above the line, this more often than not signals that the pattern will be completed with a break above the bounce rally high. I call these patterns Chinese double bottoms because the retracement towards a secondary low can often be slow and very torturous to those who are long, just like the Chinese water torture. I later read that this form of torture was actually created by the Italians, so perhaps the pattern is misnamed. The great advantage of these double bottoms, though, is that they provide a potentially high reward but low risk buying opportunity. Generally speaking, the longer the torture trend line and the more times it's been touched or approached, the more bullish the situation when the breakout finally does develop. Ironically, the steeper lines seem to be followed by the more explosive advances. In this example, the breakout from the torture trend line offered a low-risk entry point. Here's an actual example of a Chinese double bottom. See how the volume is lower on the second low and picks up on the rally. Of course, the actual breakout would have involved a very large risk, since you would have had to have ridden the price back to or below the second bottom. However, when we draw in the torture line, the breakout provided a very low-risk, high-reward entry point. Price characteristics. Two lows following a serious decline that form at approximately the same level. The two lows are separated by a rally. Pattern completed, with a move above the rally peak coming off the initial low. Volume consideration. Heavy volume on the first bottom, distinctly lower volume on the second. Very high volume should accompany an upside breakout. Measuring implications. The distance from the lower of the two bottoms projected up from the breakout point. Signs of false breakouts. A retracement of 50% or more from the second low to the breakout point. Low volume accompanying the breakout. Double patterns may extend to form triple tops or bottoms, or sometimes even quadruple or other complex formations. An example of a triple top is shown here. It's essentially two tops separated from a smaller top. If they were all the same height, it would be a rectangle. If the center top was the highest, a head and shoulders, and so forth. It really doesn't matter what you call these formations. They all reflect a battle between buyers and sellers, which sellers eventually win. The names are merely there to help categorize these concepts. The bottoms of these formations, whether it be a triple top, head and shoulders, rectangle, and so forth, represent a more or less horizontal trading range in which buyers and sellers battle it out. When the support line joining any of them is violated, the formation is completed, and the trend is bearish. The measuring implications of all these patterns is done by calculating the distance between the peak and the lower end of the pattern, and projecting this distance from the neckline. Ideally, we would want to see volume shrink on the third peak of a triple top. Like triple tops, triple bottoms experience a series of three lows, the first and last at around the same level, and the center one at a higher point. A line joins all the rally peaks, and the pattern is completed on the upside breakout. Volume is normally greatest at the first two bottoms, declining noticeably on the third, and like the inverse head and shoulders pattern, hopefully expanding on the breakout. Here's an example of a triple top for NCR at the turn of the century. Note that volume is fairly high at the first and second tops, but is not only noticeably lower on the third one, but also declining. That's not true for the downside breaker, where activity expands noticeably. This chart of Mellon Financial demonstrates heavy volume on the first two bottoms. The third is accompanied by lower volume, but nothing that's really striking. By the same token, activity rises slightly on the breakout, but nothing to write home about. It just goes to show that successful upside breakouts can develop with little activity.